This is probably my favorite episode of doing this. If I could say this should have been the first thing everybody should have seen, is how to structure your finances and how to make sure that you're going to be in a good position. If you want to do this to scale, if you want to do this to get yourself out of the 9-to-5, out of the rat race, you have to know what to do with the money. Otherwise, you're going to make a bad habit of spending money when you shouldn't have spent it, or putting money in a place that you shouldn't have put it, versus the point of let's get out of the rat race. Let's set ourselves up for the future. Here's how you do it. You put this much money in a tax account and you don't touch it. You put this much money in an account for marketing and you don't touch it. These are the things that can be make or break. Some people could literally have to go out of business because of this piece right here.
The DealMachine REI podcast. Everything you need to know to get started in real estate investing.
Hey everyone, thank you so much for tuning in to the DealMachine Real Estate Investing Podcast, where our mission is to give you everything you need to know to get started in real estate investing. So I'm your co-host, David, and with me, I've got your co-host, Ryan. Ryan, how you doing today?
I am good. I'm tired. I've driven a U-Haul truck 18 of the last 24 hours.
What? Where were you going?
So my mom moved back from Wisconsin, moved to St. Joe. So I went Wednesday, picked her up. So I got to Wisconsin. It was like 4:30 Wednesday, and then got up yesterday morning and drove back.
Oh my gosh, that's a brutal amount of driving.
It was. I was tired. I did not realize, and it was like really, really windy. And if you've never driven a U-Haul, that sucker does not handle good in the wind. So my forearms are so sore. I'm going to tell people I went to the gym.
U-Haul doesn't have power steering, huh?
Dude, well, it has power steering, but dude, when you're getting blown all over the road, it didn't matter if you got power steering or not. It was a battle trying to keep that sucker on the road.
Well, congratulations on bringing your mom a little bit closer. I'm sure that's going to be easy to visit with her and help her with anything that she needs. And did she move to St. Joe?
Yeah.
Where you live?
Yep. She actually is in one of my properties. It's kind of cool to be able to have a place for my mom to live. So.
Oh, interesting.
Yeah.
Tell me about that one. How'd you get it? Was it wholesaling during a 14-day wholesaling challenge where you got an $8,000 assignment fee using no cash or credit of your own?
No, it wasn't. It is a property. It's actually a duplex. We bought this back in January, and a realtor brought the deal to me. So it was an off-market deal. The realtor was aware of the property being, or the sellers needing to sell it. And he asked me if it was something I'd be interested in. We went and walked it, and we loved the property. It was absolutely perfect for our portfolio. And then closed on it back in January. And then my mom messaged us about a month ago and was like, hey, I'm going to move back to St. Joe. Do you have any properties empty? And I'm like, this one would be perfect. So
are you going to charge your mom rent? Is she buying the property, or are you letting her stay in it?
I don't know. I don't know how I want to deal with that. I kind of like the idea of you should treat it like you would treat everybody else. Maybe some discounts to make it, easy and palatable. And she is my mom. I don't know what, I'd love to hear other feedback from people on what do you do when you're renting to family members? Like, you don't want to just give stuff away, but it is your mom.
Well, I'm sure our special guest actually has some input on that. And just so you guys know, if this is your first time tuning in, we've done about 10 episodes of the podcast now. We covered everything from how to find one of those deals. Ryan's background is actually wholesaling, where in 2019, he did find one of those first deals in a 14-day wholesaling challenge, made an $8,500 assignment fee, and he's done 380 deals since, almost going to crest 400. Is that right, Ryan?
I think I mentioned to you the other day, we put a trailer park under contract, and I think after that, that'll push us over the 400.
Oh man, I can't wait till we can say 400. It's a lot easier than 380, almost 400.
I know, yeah.
It'll save me like 7 syllables. Yeah, and congrats to you, Ryan. I can't wait to hear how that trailer park goes. And just so you guys know, from my context, I've done I have 9 rental properties that I did direct to seller using the BRRRR strategy to basically take the property down, fix it all up, and then refinance it. So I have a rental property that's cash flowing with 25% equity that I put 0% down on. So did that several times. Haven't done one in a while because the app I created, DealMachine, started taking off, and I was focusing on that. And so now I'm really excited to start looking for deals again. I just started setting up like a phone number and answering service, so I'm pumped for that. But guys, we're going to talk about what you should expect to pay in taxes if this is your first time wholesaling, because I think it catches some people off guard. Now, Ryan, when you did that first year of wholesaling, did it catch you off guard at all with how much you should save for taxes? Because here's what I noticed. The government trusts employees. Actually, the government trusts business owners more than they trust employees, because the employees, it gets taken right out of their paycheck. You never have to think about taxes. But as a business owner, you don't have to pay it until like the end of the year or then some, right? And so if you're not saving for it, it can catch you off guard.
It definitely took me off guard. It's not that we weren't saving money back for taxes, but the thing that I always got hung up on was that so many people that I communicated with that were investing in real estate were like, yeah, we didn't pay any taxes this year, blah, blah, blah. And I'm like, I don't understand this. But we would set stuff back, but then at the end of the year when we did our taxes, it was like, well, that was still a lot of money. Year 2 was even more because we did twice the amount of volume. And I would set money back, put it here in the account that is set aside for taxes, but still there was just things I was not prepared for on that side. And at that time I did not have a bookkeeper, accountant, CPA, nothing. So it was like me on an Excel spreadsheet keeping track of everything. Sucked.
Well, here in this call, if you're concerned about how much is safe for taxes, we will alleviate that concern so you can focus on doing deals and not worry about that, and also not get caught with your quote unquote pants down, I guess, if you're not prepared to pay a big tax bill. And so I think this is the perfect segue to introduce our guest. Those on the video chat can see him already. He's a striking man from Springfield, Missouri. His name is Marcus Kriegler, and he's a real estate finance expert. And he's actually, I know him because we just work with some mutual clients, and every big wholesaler, flipper, it feels like they use Marcus as their actual CFO. And so, Marcus, it says here, I actually used the AI to pull in some of your bio. Now, I know it's not all perfect, but it says you enjoy outdoor activities as well as spending time with your family. Is that true?
Totally. Yeah, absolutely. Right. So got 3 kids, right? So you got to spend time with them, right? So I appreciate you guys having me.
Bolster yourself up a little bit more. Okay. What's your full background with real estate professionals?
Yeah, that's a great question. So I think it probably makes sense to just kind of start from the beginning a little bit, and not maybe from the very beginning. Maybe professionally from the beginning, right? So I got out of college and got into a really, really great situation with an accounting firm, and they had a specialty in actually auditing real estate apartment complexes, right? And so I got my kind of first understanding of the power of real estate by auditing them and really looking at the inside of these apartment complexes, and found, it only takes so long as an accountant when you see somebody buying it for X, running it this way, and selling it for X for you to be like, wow, this is some interesting stuff. I really need to understand it better, right? And so I kind of fell in love with real estate, and kind of over the next 5 to 7 years in that firm, I spent a lot of time studying real estate investors, built a non-audit side of the company for specifically real estate investors, where we did accounting, bookkeeping, tax strategy, tax planning, CFO type services. Ultimately, back in 2020, if you guys remember 2020, everybody tries to forget 2020, but for me, that was the year I started my own business, right? I started it in 2020 in the middle of the pandemic, and it's been a massive blessing because the passion that I have for real estate, I combined it with the passion I have for accounting, and really, really brought those two together. And I think provide some pretty good services to a lot of real estate investors out there. So yeah, I mean, if you see a lot of passion coming out of me, it's because I truly care about both of these industries, and being able to do them both every single day is a lot of fun.
I love that. And I can't wait to hear more about those apartments because, I've got some buy and holds. I'm curious, what are the 4 strategies? I always hear there's like 4 great reasons for real estate. It can appreciate, it can cash flow, it can depreciate. And there's a 4th one. You could put your mom in it. I don't know. What's the 4th one?
That's right. Well, I think there's probably more than 4 benefits to investing in real estate, but I think what I'm going to take you guys down a little bit here is the reason why you shouldn't invest in real estate, which is weird, right? Completely different, maybe direction that you guys would want to go here. But the reality is, I think a lot of us get into the real estate game and we're like, hey, I want to go buy this deal. I want to have cash flow. I want to have all the depreciation. I want to have all the appreciation. I want to have the principal pay down, right? I want to put my mom in it. I want to do all those things. But the reality is you're a real estate investor at that point in time, and investing is necessitated by money, right? Okay. In order to invest, you got to have money. So what I always tell people first, let's go make money, right? A lot of people don't have tax problems. They have an income problem. Once you start fixing the income problem, you create tax problems. Now we can solve the tax problem. But and maybe we're getting a little bit ahead here, but if somebody's got, let's just say, $100,000 tax bill, well, if you cut that by 20%, they save $20,000. That's a big day for them, right? That's great. Yeah. That same person only makes $50,000. Only pays $5,000 in taxes. 20% discount's only $1,000. Right. Yeah. So the more income you get, the bigger tax problem you have, the more important it is to invest in real estate. But in the beginning, which I know a lot of your real estate investors are going from 0 to 1. How do I get that first deal? How do I get that first assignment contract? Right. Taxes are not your problem. Income's your problem. Right. Okay. And then we're going to solve the tax side of it.
No, I think that definitely makes a lot of sense. Here's one thing that you might be able to help somebody who's brand new, though, who is going to get their first deal is like, of all the wholesalers that you work with, I mean, big ones, right? They do 100 deals plus per year. Like how much, let's say they make a $10,000 assignment fee. What do they do with that money? How do you see that being allocated? Is it like all back in the business, or is it like, let me save a little bit for profit, let me save a little bit for taxes, or what's your recommendation there?
I think everybody's different based on their strategy. And so that's what I would love to say a one size fits all, but let me give you the answer of what I would do if I was in that boat. And what I'm going to say is this boat, the beginning real estate investor that does, let's say 20 or less deals. Let's just say 20 or less deals. That's a year. And so if I'm that person, what my biggest focus is probably getting my deal done and then putting money into my tax account, right? Ryan talked about that a little bit. And I think maybe a lot of people may have skipped over that, but that's a really, really important piece to cash management and tax management. What we talk about a lot is we want to save you as much as we can, but we want to prepare you for what's left, right? Mm-hmm. And there's 2 pieces of that. Typically, when you're not a high income earner, there's only so much you can do to adjust your tax bill. So the second thing is being prepared for it. And if you're not prepared for it, typically year 2, Ryan kind of mentioned this, year 2 in real estate investing is where it really smacks you in the mouth, right? Because year 1, you're like, okay, maybe I've done a few deals. This is making a little bit of money, but I've also spent a lot of money to get here, right? I've had to reinvest in advertising, had to do these things. In year 2, now that's when you start realizing some real profits. And you're like, wow, this could actually be something. 100 grand in profits. Well, not set up correctly, that could be $35,000 in taxes, right? And if you didn't save for that, that's a big deal. So I really recommend you oversave for taxes. So even if you're not in the 30% tax bracket, I'd start at 30% of your revenue put in taxes. And what's going to happen from that is you are going to slow down your growth trajectory. And that's okay, because slow is fast, right? Mm-hmm. Somebody says slow is smooth, smooth is fast. That's exactly how real estate investors, either they fail because they're too fast, right? Or they are very successful because they're on the right pace, right? A lot of people, we saw that over the last, 6 months to a year, they got a little bit ahead of their skis and boom, they lost all of that. And so what I recommend, instead of going 2 steps forward, 3 steps backwards, let's just inch it forward a little bit at a time, save the money appropriately. Once you get to a spot where you are paying a significant amount in taxes, then you should be hiring a CPA, right? And you should be discussing your tax strategies. And we're going to talk some tax strategy. I'm not going to leave you guys here by saying, hey, save a bunch of money. You guys are newbies. You're
so
screwed,
basically,
right?
you're like, go out and make money. You don't need to hire a CPA. Focus on making the money and then save 30% of that and go spend the rest if you need to.
Yeah. So what I would say is, no, you do definitely need a CPA. The second you start a business, you need a CPA. Day one.
Yep.
You don't necessarily need to pay that CPA a whole bunch of money to create a tax strategy for you. There's nothing worse than going and creating 20 LLCs and setting up this whole tax structure when you've only done 2 deals, right?
Okay. Let's say I start an LLC and I go, hey, CPA, what's up? What are they doing for me right there? Because I don't need my taxes done quite yet. So what would they actually do?
Yeah. So the first thing that CPA is going to do, so the first thing that you have to do is you got to create a relationship. Okay.
Okay.
Relationships with your CPA is probably as important as the relationship with your banker and as important as the relationship with your attorney, right? You've got 3 people that you really need on your side that you typically aren't going to hire in-house unless you get really big.
Yeah.
Attorney's one of them, CPA is one of them, and a banker's the other, right? You need all 3 of those on your side. So you're starting that relationship, and it's more than just, hey, can you do my taxes
at that point? That's what I'm like. If I walk into your office, I haven't done a deal, but I started an LLC. Like, are you taking the meeting with me?
Probably not my business.
Okay.
Right? Probably not my business.
Yeah. Would you charge me for anything at that point? Or when was the first time we would actually be charged for something or get advice? You know what I mean?
That first initial consultation. They're going to charge. They should charge you. They may do it for free. But if they're giving you value, then you should pay them for that. And that might be $150. And I know for some people that's more than for other people, but I will tell you, if you're serious about getting in real estate and you're serious about setting this up from the beginning, going and spending $150 with a CPA to make sure that you are set up from the beginning could be all the difference in the world in making sure that you don't get, pushed back down the ladder later. Right. Okay. So for instance, if you make that $100,000 and now all of a sudden you got to come up with that extra $35,000 in taxes, all of a sudden your business changes drastically and your momentum halts. Right.
Yeah. You're spending all your time trying to make up what you should have saved from the very beginning. I've been there. Like, that was a mistake that we made. Is year 2, we brought in, I don't know, 300,000. It was like, I was like, what in the world is all this money? Like, what do I do with all of this? And we tried to save some, back in taxes. But again, I did not have resources like a Marcus that could show me how to properly do it. Or there's so many people out there that, like, I think we talked about, why can't I think of the book? Profit First.
Mm-hmm.
So we talked about Profit First. It's like, I didn't have those resources when I started this. So I was doing this. I was making a bunch of money. And then year 3, I'm sort of trying to chase what I've accumulated as a tax bill because I wasn't properly set up. Mm-hmm. So, like, I agree. Like, people underestimate why this is an important step. I certainly did. I did not. I mean, it wasn't part of the 30-day wholesaling challenge. It wasn't, oh, hey, day 1, go get a CPA. That was not there. It was day 1, go get a deal. But what we should have said is the 31 day, you should have went and got your CPA so that what do I do with this $8,500? Because it's not just go and spend it. You have to have a process to put that money in the right buckets, or you're going to be chasing your tail forever.
Yeah.
Mm-hmm. Marcus, what are the business sizes that you guys would typically work with when it comes to people who are wholesaling?
That's a tough question. I think most of our clients hit the 20 deal a year mark or more. Most of them probably most of them are at 50, but certainly 20, we probably are too expensive to make it make sense, right? There probably are less expensive options and probably better fits at that smaller level. However, I think a lot of the information that you need, we can talk about. Like we talked about setting up an LLC. I don't know about the 14-day challenge if one of the things is setting up an LLC, but I think that's a good idea. What is that? So an LLC, when you set it up and you own it individually as one owner, it's a disregarded entity, right? That's what they call that. You own it 100%. It ends up on your personal tax return, does not create an additional tax filing, and everything goes to you, right? Typically, the difference, and probably what Ryan would have had a lot of benefit from, is a consultation with his CPA once they started making about, let's say, $80,000. If your wholesale business is making about 80 grand, you can't wait any longer to meet with your CPA. And don't wait till the end of the year after it's already said and done. And you're like, oh, I made 80 grand. No. We're in March. You know kind of where you're at right now. If you're having an okay year, this is the time summer's a great time to talk to CPAs, right? Because they're not super busy. Traditional CPAs aren't as super busy. They'd be happy to sit with you and make $150 for the hour they're sitting with you, right? And so that's a really good time going into summer saying, okay, I think I'm going to be able to make that 80. I should be considering turning this LLC into an S-Corp, right? And so but $80,000, I believe, is where it really starts to make sense to do that. And that's just a little.
Yeah, I mean, I would agree with that from my experience.
Can I stop right there?
Please.
So I know that was the very first thing that at that time, our CPA, that was the very first thing they did, is like, we're moving this LLC to an S-Corp.
Yep.
I still, to this day, have no clue what that did.
Yeah, great question. So when you when you are an individual and you own that 100%, it's looked at, I said the word disregarded entity, right? And the LLC is only there for legal protection, right? Everything else just comes to you individually. So you pay all your income tax and you pay all your self-employment tax. So let's say you're making 100 grand a year. Let's say your effective tax rate's 25%. Plus you got an extra 15.3% of self-employment taxes on top of that. So you're actually paying 37%, right? Or 40%, right? So your tax bill increases. Well, what happens when we switch to an S-Corp? The S-Corp now becomes a business, right? It is no longer looked at as Ryan's disregarded, everything goes to him. The S-Corp is its own business, right? And so what happens is Ryan's now an employee of that business. He needs to get a salary coming out of there, a reasonable salary. There's a conversation on how that salary is determined, but ultimately a reasonable salary. And then everything else that goes to Ryan out of this business is called a distribution. Well, the great thing about a distribution is it does not have self-employment taxes associated with it. So let's say you're paying yourself $100,000 salary, but you distributed yourself $200,000. Instead of paying that 15.3% on the 300, you're going to pay it only on the 100. And that's an oversimplification of it, but generally that's the reason why you go to an S-Corp, because it's saving you in self-employment taxes. But that saving in self-employment taxes does not come without some cost. The cost associated, you now have to run payroll for yourself. You're an employee. You're an owner, but you're an employee. So you have to run payroll for yourself. You have to keep books and records. It's not an option anymore. You have to keep accounting. Now, it doesn't have to be QuickBooks, right? I prefer QuickBooks. It's easy. It's simple. It's straightforward. Once you learn it, you can do it in your sleep. I don't recommend you do it, but once you learn it, you can do it. But you have to do that with an S-Corp, and you've got to pay yourself that reasonable compensation, right? It's got to be enough. If you're making $1 million a year, paying yourself 50 grand ain't going to cut it, right? The IRS is not going to love that. So that's probably the first thing. And I think most wholesalers, between going from that $80,000 to probably $300,000 a year in income, that's going to be the majority of your tax savings there. Now, there's some other things that we can talk about, but that's going to be a lot of tax savings just in making that conversion.
Mm-hmm. Oh, that's really smart. So where do you think somebody should go to start getting their books kept? Because I know a lot of entrepreneurs, they're not really great at those tiny details. And so if they're like a one-man show and they're probably not keeping books, at what point should they get a bookkeeper, and like how should they pick somebody like that out?
Totally. Good question. So it's tough. It is tough. I'll be honest with you. There are not a ton of just awesome bookkeeping options, right? And it's not necessarily the fault of anybody. It's just that accounting for real estate is hard. If it's just a wholesale business, if you're just a wholesaler, and I don't say just a wholesaler in the sense that that's not a big deal. It's that it's very simple accounting. Wholesaling is simple accounting. When you start adding rentals and fix and flips to the board, now it becomes a lot more complex. You've got fixed assets, you've got work in process, you've got cost of goods sold, right? You've got a lot more work to do. So if you're just a wholesaler and you're only doing wholesaling, then a bookkeeper that is probably either part-time US or part-time overseas, making sure that they have a good process by which they're closing your books, making sure that you have an understanding of what it looks like to close the book. So I think that's the other thing I will say is business is about accounting. Always. It's always been about accounting, and it's not going to change, and it's not going to change the business. And so if you really want to be successful at business, you need to understand accounting. And so a lot of people come to me after they've hired that bookkeeper for a couple of years, and they've been very successful, or they've got some success, and I go to them and I'm like, hey, I got really bad news. We got to clean up all your books, and it's probably going to cost you $15,000 to clean them up.
But that's like a big operation. Yeah.
But the funny thing is, it doesn't have to be that big of an operation, David.
Got it.
Because what can happen is all of a sudden, you thought you were going to wholesale, you were only going to wholesale, now you took down a couple properties. Well, you took down a couple properties, but you didn't. Your old accountant didn't know how to handle those properties. They knew how to do a wholesale, but they didn't know how to do a fix and flip or a rental. And so now all of your expenses are miscategorized. Maybe they were expensed when they should have been capitalized, right? So there's a lot of potential issues where you could maybe flip 10 houses over 2 years, and we've got to go back and recreate all those sets of books. I mean, that's 2 years worth of financials. So it can add up very, very quickly. So what I would say is this: if you're going to wholesale, you can outsource your bookkeeping to a lot of different people. They don't necessarily have to have a specialty. It's a cash in, cash out business, right? Fairly simple. If you start fixing and flipping, if you start doing rental properties, then you need to get an industry expert. No doubt in my mind, probably the most overpaid taxes are due to bad bookkeeping.
Okay. That makes total sense. One thing I was thinking of is like that $10,000 wholesale deal. I know you said save 30% for taxes.
Yep.
Am I paying taxes on the whole 10,000, or if I spent 5,000 to get, 5,000 in marketing to get that $10,000 deal, would I only be paying taxes on half of the 10,000?
So you're another level, right? That's an advanced level. It is much easier for somebody to say, okay, I made 10 grand. I'm going to put 3 grand into savings, right? What really and truly, when we're working with our clients, we're analyzing the tax bill based on net profit, because that's what actually gets taxed. When you're saving for taxes, though, it is much easier to say, okay, I'm going to take a percentage of this deal and I'm going to stick it in my tax account and forget about it until I'm ready.
It's a separate bank account that you wouldn't pull money out for any reason other than to pay your taxes. Yeah,
pay your taxes. And then the other thing is to undergo tax saving strategies that you would otherwise, that's eliminating the tax that you would have to pay, or reducing the tax you have to pay. So you could use it as an investment vehicle as long as you're investing in a tax advantaged piece of real estate that makes sense.
Yeah. Right? So how much of the $10,000 deal should I take to live off of or spend it? Like I said, not on the business, but on myself.
I guess what I would say is, what's your goal? If you came to me and said, hey, my goal is to do one wholesale deal and make 10 grand off of it, then probably what I would do is I would probably say, okay, it cost you $5,000 to get there. You're going to net $5,000, probably go put $1,500 in a tax account and go blow the rest. And if that's what you want to do, you're probably secured and you're good to go. I think the best real estate investors come at this with a strategy, though. And so if you go out and you just want to get your first deal and do it and try it, that's one thing. But if you want to create a business out of this, then while it is a fact that you can get started in this business for little or no money, when you start making a little bit of money and you can dump it back in the business and you can start that flywheel effect, that delayed gratification is a massive benefit. Massive benefit. That's how you really start circling. That's how, I mean, I've seen it time and time again where I start with somebody that's doing 20 deals a year and they're doing 200 now. And it's really just comes down to they reinvested the capital back in the business. They saved appropriately. They didn't have to take massive steps backwards. They didn't over leverage themselves with flips. That's another thing, right? They didn't go crazy and chase after every penny. They stuck in their box and they just kept their head down and kept focused. And so if that's your strategy, then I think what you have to do is you have to figure out how much do I have to have out of this business, and then what else, and then dump everything back in strategically, not unintelligently, right? So what I tell people a lot is a lot of people, their first deal, they want to go buy a rental property, right? First deal, go buy something. I want to hold on to something. It's an asset. That's what we've all been told. That's what Rich Dad, Poor Dad told us. We want assets. I agree. But what gives you a better return on your money? DealMachine or a single family house?
Well, it depends on if
Deal
I'm
Machine.
working or not. But for me,
Sure.
I mean, DealMachine is a $13 million a year company.
Well, and I mean just the investment in DealMachine, right? So if I got say I got that $5,000, and that $5,000 was enough to allow me to put, my 5% down on an FHA property and buy a property, right? You could do that with $5,000, or you could put that $5,000 back into a marketing channel like a DealMachine, and anybody that's okay at marketing is going to get a 2x return on that, and that's bad. That's not even okay. That's bad. Okay is 3x, good is 4x, 5x, 6x. So you can turn that $5,000 into 20, into 80, and so on and so forth. And that's how I see people really grow this business, is not get too focused on buying that rental property too quick because it eats up your liquidity. And, if you can delay that gratification and get to a spot where you're making $50,000 a month, you can buy a property a month, right? Instead of just one property at one time. But everybody's strategy is different. Maybe their goal is just to buy that one property one time, do one wholesale deal to do it. So it all depends, I guess.
Early on in my journey, year one probably, when we were doing, I don't know, we did 73, 74 deals year one. I started making a habit of whenever I'd close a transaction, I was taking 10% of whatever my assignment fee was, and I dumped it back into sending postcards. So every month, if I did $20,000, I was spending $2,000 in marketing. And that's what compounded my success. That's what kept, the phone was ringing off the hook, because I was constant. It wasn't just wholesaling, 30-day wholesaling challenge. You go out and you get 250 properties or whatever the number is. You go out and do that. Well, then what? What do you do next month? Another 250? Well, it depends on what your growth strategy is, because for me, I'd close that deal. I would take whatever I closed on that first deal. So $850 was my marketing budget. And as the more deals came in, the more money I was spending, the more postcards I was sending, the more list I was pulling and just blasting it, because that's what was growing. It was compound growth. You would take just a small portion of what you're doing in the assignment fee, dumping it back into marketing, and that is blowing the roof off of what income you were then making. That's honestly what it happened so quickly that I wasn't prepared for that. Making that simple move of I'm sending so many postcards. I would love to go back and look at how many postcards I sent year one versus what I'm doing now. I bet you that would tell a story in and of itself, because that growth and that number of postcards is what made our growth happen so quick, that it put me in a position of, I wasn't ready for that. I didn't have the proper channel set up. I didn't have a CPA. I didn't have any method of keeping books at all. Like, it was such a mess that's why we have this kind of call. Like, this is why it's important, before you go out and do $30,000 a month in wholesale fees, know what to do with that.
Yeah. It's really, really easy to scale this business with money, right? You can dump more money into marketing, right? That is not the problem of this business. I think scaling intelligently has always been the problem, because it's so easy to dump money into marketing, right? You guys create a platform where it's easy to go put money into marketing, but it's not easy to maximize the value of that marketing to ensure that you're getting the returns that comparatively, if you go back to the number of postcards you sent out your first couple of years, I bet you'd find that, hey, if I had those same opportunities this year as I did back in back when I was beginning, I'd double my income, right? Because I'm better at what I'm doing now, right? So I think that's another thing of, hey, yes, you can put a lot of money in marketing, but you should probably get good at what you do first. And if you're only on your first, second, or third deal, you're not good yet. No way. You can't be. So I think again, slow, smooth is fast. Get your feet underneath you, understand the accounting, understand the marketing metrics. And by the way, your marketing metrics are probably going to get worse as you get bigger. That's an interesting thing that happens, right? When your boots on the ground, your marketing metrics, you may be getting an 8x return, 10x return. Yeah. Once you get bigger and you got people involved, that's the other thing. When you scale it, you got to scale on the backs of people. And that's a whole nother business strategy in and of itself. And we could do another 2-hour podcast on this, right? But now you've got scale up with marketing. Now you got to get people. You're going to get a less return on your marketing because those people just naturally don't have the skill set that you've developed, right? Mm-hmm. And so I think it's important to realize that if you go too fast, you can go backwards. And sometimes you can go backwards so far it's hard to recover from. And so I want everybody to be really, really successful. I've seen what works and what doesn't. And slow down. I promise. You'll thank me for it in 2 years if you slow down a little bit today.
I can say we've had that moment of slow down even now, even this year. We've put ourselves in a position where it was like, okay, our beginning of the year goal was 3 million. And then I'm like, oh, let's slow this down just a little bit, because I don't know what I'm going to do with 3 million. I don't know how to structure this. I don't know how to set this up. And is it necessary? It's okay to acknowledge when you're moving just a little bit too fast for yourself. If you can actually say that to yourself of I'm going too fast, because there is such thing as going too fast. And I've been there and it was fun, but it also kind of puts you in a position of then you're trying to catch back up on what you didn't do right. And this is, again, this is probably my favorite episode of doing this. No offense, David. This is, if I could say this should have been the first thing everybody should have seen, is how to structure your finances and how to make sure that you're going to be in a good position. If you want to do this to scale, if you want to do this to get yourself out of the 9-to-5, out of the rat race, you have to know what to do with the money. Otherwise, you're going to make a bad habit of spending money when you shouldn't have spent it, or putting money in a place that you shouldn't have put it, versus the point of, let's get out of the rat race. Let's set ourselves up for the future. Here's how you do it. You put this much money in a tax account and you don't touch it. You put this much money in an account for marketing and you don't touch it. These are the things that's like, it can be make or break. Some people could literally have to go out of business because of this piece right here.
You know, it's interesting you say the rat race, and I find that what happens a lot of times is people will leave one rat race for another rat race, right? Real estate is just another rat race if you allow it to be. This concept of freedom in real estate is bogus, but real estate does not create freedom. Your strategy in real estate creates freedom. No different than David's strategy in DealMachine creates his freedom, right? Yep. It's real estate can create freedom, but it can also eliminate it if you don't do it right. And so that's why I have that passion about just start it the right way. I know that it's easy to get into. I know there's not a lot of barriers to entry, which is why it allows us to have this massive success, have people go from literally making nothing and making millions of dollars. Like there's probably very few industries aside from tech that allows us to do that. And tech obviously has a whole nother threshold of risk associated with it. So behind tech or in front of tech is real estate. And if you allow it to, it can ruin your life and you can make a ton of money while it ruins your life.
Yep. Have you seen that Instagram post where it's like, yeah, I quit my job so that I could live for free, and now I work 80 hours a week.
It's true though. It is true. Now you at least get to pick a little bit of that 80 hours. Like you could go golf, you can have lunches on your own.
That's true.
You can be on your phone. Like at least it's 80 hours that you have a little bit of say in. But right. It is the truth.
100%. 100%.
I think that was going in a good direction. What other questions are on your mind, Ryan?
Oh man. I don't know. I feel so fulfilled with knowledge. I hope, like I said, I hope that people take this episode and really just implement this piece, like, because this is so crucial to growth.
Yep. Yeah. I mean, people, what I don't want to do is turn someone off about this right now when it takes them 6 to 9 months to even find their first deal. You know what I mean?
For sure.
This isn't really, they're not ready to hear this yet. Okay.
Yeah,
so
you're right.
If you're talking to somebody who's done a deal, can you succinctly kind of summarize again, like the ratios that we think they should be saving, reinvesting, and then living off of?
Yeah. Well,
because at that point you said they need to have a goal and a strategy, but I would say they're just trying to make it. You know what I mean? They're just trying to get to 10 deals, and so that's where I would be wanting to give that person advice right now. So
I think, but that 10 deals, okay, let's talk to that person. If I'm doing a conference with somebody, let's just do that. Let's play that. If I'm doing a one-on-one conference with somebody that their goal is to do 10 deals, here's what I'm going to kind of advise them to do. Let's say average deal size 10 grand. So they're looking to make $100,000 revenue this year, right? So my first question is going to be, all right, let's say we got the LLC set up. I'm going to say, hey, at the end of this year, if you're successful and you do make that 100 grand, we may do an S-Corp election. We're going to have to see, but we may start thinking about that, but we're not going to do it yet. So I'm going to throw that out the window. We're not even there yet. But you do have an LLC for legal liability protection. You've worked with an attorney to set that up. You've got what you need there, right? The next thing I'm going to do is I'm going to say, okay, let's throw away taxes. You have an income problem, not a tax problem. Let's start talking about what you're going to do after that first deal. How are you going to get that first deal? All right, you're going to come in, you're going to go driving for dollars. How much money is that going to take? It's going to take $1,000 to get your first deal. It's going to be a $10,000 deal. In theory, you should have $9,000 left over. Now what? Right? And so what I would say is you still have to create the strategy if you want the 10 deals, right? But I'm going to sit down with them and talk through that strategy. Okay, we want 10 deals at $100,000. We think our marketing is going to cost us about $30,000. We're going to hire an administrative assistant this year that may cost us $10,000. So we're going to net 60. Of that 60, if we don't do an S-Corp election, you're probably going to pay about $18,000 in taxes. So let's start figuring out how we're going to save for that. If it's $1,800 a deal because you're going to do 10 deals, boom, now you know, right? We're going to take $1,800 a deal. We're going to do 10 deals. So that's kind of what I would look at is I would really start drawing the picture, because I think that person that is trying to go from 0 to 1 is stuck because they don't have a real strategy.
Yeah. Cool. I really appreciate you summarizing that. What other advice, Marcus, would you have to give that we haven't covered yet?
Well, I would say I'd just go back to what you said there. And I don't want to discourage anybody from getting in this business. I don't want to discourage anybody one bit. I think it is the most amazing business that I've seen. And listen, I don't actively do the business because I have an accounting firm that I want to focus on, and that's my cash flow business. But I can tell you that my wealth business is real estate. That's where
do you invest in real estate then? The money that you make in your accounting business?
Nope, absolutely not. It all goes back in my business. So my business is no different than a wholesale business. No different. It's the same thing. It is just that I'm taking that money, and instead of going and investing in real estate, I'm putting it back into people, processes, procedures, because I'm going to grow up and be like Ryan one day, right? And so that's what I'm doing. And so I recommend you do the same thing, but that's not what you have to do. That's not what everybody has to do. Not everybody has to get into real estate to grow a massive real estate business. I actually think there's a really cool method. If you're a W-2 employee and you're, even a middle earner W-2 employee, and you want to buy a house a year or buy a house a quarter, buy a house a year just to start stacking up some rental properties, that's a really, really good idea. Now, the tax benefits aren't going to be massive, right? That's not going to really be what the tax benefit. You're not going to get massive tax benefits. You might get some. But I think it's still, if you want to do a house a quarter, you still got to have a strategy behind it. You still got to make that decision, because that's what my decision is. I'll tell you, whenever I go that direction of getting back into real estate, I've done 3 deals myself, decided, hey, too much of a lack of concentration on my business, that I want to focus my time there. But once it's time, my model is going to be going direct to seller, buying the house, using the capital that I generated from my accounting firm to buy the house. Maybe I can get it at enough discount where I can do a burst strategy. Maybe I can't, but I'm not determined. Like, I don't have to buy it without cash, right? So that's a nice benefit for those of you with W-2 jobs. You can kind of save up a little bit of money so you don't have to burn if you don't have to. And then ultimately grow yourself a portfolio of 10, 20 houses. You can get nice low money down loans. You can get nice 30-year loans. In a lot of these deals, I love the idea of house hacking, right? If you're new to the game, if you're not familiar with house hacking, you should look it up. Could be a massive, massive wealth growth opportunity there. But that's what I would do, right? If I'm that W-2 employee that's trying to just build my retirement because I don't trust the 401k, I don't trust the stock market, that's a awesome strategy. And I think that's the way you should do it. And maybe it happens to where you decide to get out of the industry you're in and go full-time real estate.
Mm-hmm. Well, yeah, I loved how you talked about, how you think about your accounting business and the deals that you did and how you'll actually do that whenever you want to do real estate investing. Ryan, anything else before we sign off?
I'm good. Thank you, Marcus, so much. I think that this is going to help everybody, from people that are doing their first deal all the way to the people that are scaling. I think this is good for everyone involved. Is good for me. I appreciate it. So yeah, I'm grateful for you getting on here and sharing some gems.
Anytime.
Thank you, Marcus. I really appreciate it. All right, guys, we'll see you on the next episode.
Thanks for listening to the DealMachine Real Estate Investing Podcast. Please leave us a review and follow along wherever you're listening to your podcast.